Hello, and welcome to another session of Stop, Look, Listen, and Learn. Today we're going to be introducing two risk management concepts. The first one is value at risk, or VaR for short, and the second one is expected shortfall, or ES for short. I'd like to proceed today by first defining what VaR is, and after giving a definition of VaR, I want to walk through an example that demonstrates how you actually calculate VaR. And after doing that, we'll discuss some of the limitations of VaR, and then we'll conclude this session by briefly introducing the concept of expected shortfall. So first, let's start off by looking at what exactly is VaR. VaR is basically a measurement tool for market risk. And it was developed back in the 1980s, and it was widely adopted by risk managers and regulators alike. And essentially what VaR does is it defines what a bad day is in a statistical sense. And it essentially does that by carving the universe up into two pieces, or two parts, if you will. So there will be an upper desirable part and a lower undesirable part. And what VaR says is that based on historical data, there's going to be a certain probability that you will end up in the upper desirable part, and there'll be another probability that you will end up in the lower undesirable part. And that's essentially what VaR does. And VaR is that bad day, and that bad day is defined as a certain amount of losses that your firm will incur over a certain period of time, with some level of probability attached to sustaining losses of that amount. So that'll be more clear when we walk through the example. So let's now look at how you actually calculate VaR to make this a little bit more tangible. So let's start off by assuming first that we're going to have $1 million portfolio, and this portfolio is going to be invested in equities or fund that will track the S&P 500. And we're going to assume that it perfectly tracks the S&P 500, which means that there will be no tracking errors. So the returns of the S&P 500 will be the returns on the portfolio. And we're going to assume that the daily returns of the index and the returns of the portfolio, because it's perfectly tracking the index, will be normally distributed with a mean of, or an expected value of 0% and a standard deviation of 1%. So what that means is that the return on our portfolio in this example is going to be a random variable with a mean of 0 and a standard deviation of 1, and it's going to be normally distributed. And what that means is that when you draw VaR, or when you create VaR, which is going to be a line of demarcation that dissects the universe into the two parts, that where you draw that line will be determined by something that's called the confidence level. And what that basically means is, let me just illustrate this. It's probably easier to just walk through it here. So the returns will be normally distributed with a mean here, mu equal to 0%. Now, VaR is going to drop a vertical line of demarcation through the universe that will create the two parts. And let's say that VaR ends up being here. So what that means is that you're going to have a certain percentage of the losses or returns in the tail here, and then over here you're going to have the rest of the data. So let's say this is -1 here, meaning that VaR is 1 standard deviation below the mean. Then what that means is that 16% of all of the values will be here, and it'll be to the left of this 1 standard deviation, and 84% of the values would be to the right of that 1 standard deviation here. So what the confidence level says is that I am 84% confident that I'm going to end up in the upper, more desirable part of the universe. And it says there's a 16% chance that I will end up somewhere in the lower, undesirable part of the universe. So that's basically what VaR does. Now let's put some numbers to it. So let's say we have the $1 million portfolio and we want to create or calculate what is called so we're gonna start off with this example here. So this is going to be what we call the 16% VaR. So written like this, VaR 16%. And what the Z-score is gonna be -1 because it's one standard deviation below the mean, and to the left of one standard deviation will be 16% of all of the data, assuming a normal distribution here. So if we want to create or calculate what the VaR is, what we would say is that we're going to take 0%, so that's the expected return. We're going to subtract from that expected return the product of 1 and the standard deviation, which is 1%. And we're going to multiply this whole thing by the value of the portfolio, which is $1 million. And once we go through all of the arithmetic here, what we see is that the VaR, 16% VaR, is going to be equal to, $10,000. Now, what that means is that, here's how you interpret this. You say that there is a 16% chance that over the next trading day, the losses that our portfolio sustains will be greater than $10,000. And there is an 84% chance that over the next trading day, the maximum loss that our portfolio will sustain will be $10,000, or it will make a profit. So in other words, we're 84% confident that we're either gonna make a profit over the next trading day, or if we do sustain losses over that next trading day, those losses will not exceed $10,000. So that's essentially what VaR is. So it's creating those two parts. So the upper, more desirable part and the lower, undesirable part. If you're in the upper, more desirable part, then essentially you have a situation where you might sustain some losses, and if you do sustain losses, your losses are not going to exceed $10,000. But in addition to that, you could earn profits, and there's no limit to the amount of profits you can earn. So your profits, in theory, could be infinity. So that's why this part of the world is going to be much more desirable than this part of the world. Because in this part of the world, you're saying we're going to have losses that will be greater than $10,000. And in addition to that, we don't know how much our actual losses will be. We just know that they're going to be more than $10,000 according to VaR. Now, it could be $10,001, or it could be $20,000, or it could be $200,000. theoretically it could be $1 million because that's the value of our portfolio. Now, if we wanted to calculate, say, the 5% VaR, which is the one that's typically used, then we would do the same thing. So we would have 0% here, and we would subtract from that. Now, this is, let me just change colors here. So this is the 16% VaR, then the Z-score is 1, but if you drew the VaR here, so that 5%, let me just draw it all the way up here. So that 5% of all the data would be to the left of this red line, and 95% of all the potential returns would be to the right of that red line. Then the Z-score here, which is basically the quantile, would be 1.6 or negative 1.65, or if you, some people say negative 1.645, let's just round it up to negative 1.65. So what that would mean is that it would be minus, and then you would drop this negative, or you drop the 1.65 in here, which is the Z-score, multiplied by the standard deviation, and then you're gonna multiply that again by $1 million, and then that is going to give you the amount of the VaR here, which is going to be $16,500. So that would be the 5% daily VaR. And again, the way you interpret this is by saying that there is a 95% chance that over the next trading day, our portfolio will either sustain losses or will generate profits. And if our portfolio sustains losses, we're 95% confident that those losses will not exceed $16,500. But we could have smaller losses than this, and we could also have profits, and those profits in theory could go all the way up to infinity. And the flip side of that is there's a 5% chance that over the next trading day, our portfolio will sustain losses in excess of $16,500. But again, it doesn't tell us how much the actual losses will be. It just says that the losses will exceed $16,500. So the actual losses could be $16,501, or it could be $650,000. And in theory, it could be $1 million because that's the value of our portfolio. And so what risk managers do is they first determine what level of confidence they want to have in terms of looking at what the maximum losses would be. And as you can see, the further into the tail you go, the greater the VaR will be. So for example, if a manager says, I want to have 95 or 99, I want to be 99% confident in knowing what the maximum loss that the portfolio will sustain over the next trading day, then the line of demarcation or VaR would be here. And let's see if we draw this line all the way up, and that means that 1% of all the potential outcomes would be to the left of this point, and 99% of all the potential returns on the portfolio would be to the right of this blue line. And if the VaR line is drawn here, then this number here is going to be minus 2.33. And so, as you know, these are z-scores. So what that basically means is that this return would be minus 2.33 standard deviations below the mean or the expected return on the portfolio. And then if we want to calculate this would be the 1% VaR, that would be equal to the mean of 0% minus 2.33 times the standard deviation, which is 1%. And again, all of that is going to be multiplied by our $1 million portfolio, because that's the value of the portfolio. So then we'll have the 1% VaR, that is going to be equal to 23,300. So again, what this is saying is that I am 99% confident that over the next trading day, our portfolio will either sustain losses or generate gains. And if our portfolio sustain losses, I am 99% confident that those losses will not exceed $23,300. By the same token, I acknowledge that there is a 1% chance that over the next trading day, our portfolio will sustain losses in excess of $23,300. But again, we don't know what those actual losses will be. They could be $23,301 or $230,000, and theoretically all the way up to 1 million, because that's the value of our portfolio. So as you can see, the VaR carves the universe into two pieces, as I said earlier, and the upper part of the universe would be the more desirable part, because here you will have a minimum, you know what the maximum loss is going to be, or you're a certain percent confident of what the maximum loss will be, but you could also have profits, and those profits don't have a limit. And also the complement of that is, you know that there is a certain percent chance that you're going to have losses in excess of whatever the amount is. And these amounts here, the 23.3, the 16.5, and the 10, those numbers represent the VaR in each case. So here, the 16% VaR would be $10,000. The 5% VaR would be $16,500, and the 1% VaR would be $23,300. Now, as I've indicated with each of these VaR calculations, if we're in the tail to the left of the VaR amount, we do not know where we're going to end up, or in other words, we do not know how much the actual losses would be. And that's one of the major drawbacks of VaR. It tells you, okay, there's a certain probability that you're going to have losses in excess of a certain amount, but it doesn't tell you how much those losses would be. So imagine if you were a portfolio manager and you went to the risk manager and said, okay, take a look at the portfolio and look at all the statistics and the like, and give me a sense of what kind of risk we have. And the portfolio or the risk manager will look at all the statistics and the like, and he'll come up with a VaR number, and he'll come back to you and say, well, based on all the data that I looked at, I think there's a 95% chance that over the next trading day, the maximum loss that the portfolio will sustain will be $16,500. That would be the maximum loss, and we could incur losses that would be less than that, and we could also incur gains. But there's also a 5% chance that over the next trading day we can incur losses that are in excess of $16,500. So if you are the portfolio manager, your next question is going to be, okay, well, assuming that we are in the 5% or we're in the lower undesirable part of the world, how much will we lose? And the risk manager is not going to be able to tell you that based solely on VaR. All he or she will be able to say is that there's a 5% chance that our losses over the next trading day would be greater than $16,500. And that's the major drawback to VaR. Now, one thing I want to briefly mention here, we've been talking about the daily returns. You notice I said over the next trading day, but you can look at other time periods. You could look at what would be the maximum loss we would sustain over the next week or over the next month or over the next year. And so essentially what you would do is you would scale the VaR. And so here is the key takeaway with respect to that you definitely want to make certain you understand for exam purposes. The return, say, let me just write it as R here. So the return on the portfolio, that scales with time. But the standard deviation of the returns of the portfolio scales with the square root of time. Now what that means is, well, in this case, the expected return is 0, so 0 times anything is going to be 0, so that kind of drops out. But here, if we wanted to say, okay, well, what is the weekly VaR 5% VaR? Then what we would do is we would take the standard deviation, which is 1%, and then we will multiply it by the square root of 5. And that's because there are 5 trading days in a week, and the volatility or the standard deviation scales with the square root of time. The return scales with time, and the variance also scales with time. And then of course, the standard deviation of volatility is simply the square root of the variance, and that's why it scales with the square root of time here. And so just looking at what this number here would be, let me just get my calculator out here. So we would take square root of 5 times and so this is going to be 0.224%. So the daily standard deviation is 1%. The weekly standard deviation would be 2.24%. And you would multiply that by the 1.65, and that is, so take this 1.65 times the weekly standard deviation, and that will give you 0.09, and then you multiply this by the $1 million value of the portfolio, and that's going to give us $36,895. So this would be the weekly VaR. So this is weekly VaR. And so as you can see, as you increase the confidence level, the VaR increases. Also, if you increase the time period over which you could sustain these losses, the VaR also increases. And so in a nutshell, that's basically what VaR is. And you just figure out where that dividing line is going to be that separates the universe into the two parts. And then you use this general formula here, which is VaR. Then I'm going to put, that's the z-score with the alpha, and alpha is the level of significance. So if you want a 1% VaR, then alpha would be the z-score when there's 1% to the left of the line. If the level of significance is 5%, then that would be the z-score when there is 5% of the potential returns to the left of the line. And in that case, the z-score would be negative 1.65. And so that would be equal to the expected return minus the z-score based on the level of significance times the standard deviation. And that is the formula that you used in to determine what the VaR is. And what the managers will do is, first they'll determine, okay, how confident, what level of confidence we want to have, and that will tell them what the level of significance would be. So for example, if the manager said, I want to be 90% confident that we're not going to lose more than X dollars over the next number of trading days, well then you figure out what the z-score is when the level of significance is 10%, and you take the standard deviation. Usually you start with daily standard deviation, and then you scale that up to whatever period that you're interested in, and you also would scale up the amount of the expected return, or the expected daily return. You would scale that up to whatever period, be a week or month or a year, and then you would drop those numbers into this formula, and it would tell you what the VaR would be. And in a nutshell, that's what VaR is all about. And on the exam, you just need to be able to walk through these calculations here. Now, I want to conclude by briefly introducing the concept of expected shortfall, because with VaR, we don't know how bad things can get. All we know is that, okay, well, over the next day or the next week or month, our losses can exceed the VaR amount, but we don't know what those losses would be. So that's where expected shortfall comes in. And what expected shortfall does is it just takes all of the potential losses to the left of the VaR amount, and it just takes an average of them. So you take all those losses and you divide them by the number of losses in the tail. Now the key point to realize or to take away from this is that when you calculate the expected shortfall, you do not include the VaR amount here. So if the VaR amount, say the 5% VaR is $16,500, then what you would do is you would take all the losses in excess of $16,500 and divide the sum of all of those losses in excess of $16,500 by the number of losses that you would have. And so that's what you would do if you had a discrete number of losses. Now, if you assume that the losses or the returns are normally distributed, then there's a fancy formula that you need to know for the exam. And essentially what that will do is it will tell you the expected shortfall is equal to the expected return, and that would be add to that, this is return on the portfolio, the standard deviation of the portfolio, and then the standard deviation of the portfolio is going to be multiplied by E raised to the, then you're going to have the Z squared divided by 2, and you're going to raise E to that power, and then you're going to divide by 1 minus X, then you're going to multiply that by 2 times the square root of pi, and that will tell you what the expected shortfall is. And one key point is that the expected shortfall will always be greater than the VaR. And so that's another point. Let me just write that in a different color. So that's another point that you want to take away for the exam. And so expected shortfall gives you some sense of what the actual losses are likely to be if you find yourself in the lower undesirable part of the universe, and it gives you some sense of what the losses are exactly or likely to be, and that's the average of all those losses. So hopefully you found that helpful, and you now have a better understanding what VaR is and how to calculate VaR, and also what some of the limitations of VaR are. This is the major limitation of it, but there are other limitations that I won't go into now. But if you have understood all of this and can do this confidently, you're going to score a lot of points on the exam, because if you get a question on VaR, it's going to be very likely along these lines here, where it'll give you some data and they'll tell you that the returns are normally distributed and what the mean is and what the standard deviation is. And typically what they'll do, likely they'll maybe give you what the daily expected return is and what the daily standard deviation is, and then maybe ask you for what the monthly VaR would be at a 5% level of significance, or what the monthly VaR would be. And so you have to take the daily data that they give you and scale that up to get the weekly data, or get the weekly data or the monthly or the annual data. And generally what they like to do is report things on an annual basis. So they'll give you the daily metrics, and you have to compute what the annual VaR would be. And what you would do is, and that would be pretty straightforward, what you would do is you would take the expected return on the portfolio and you would multiply that by 252, because that is the number of trading days in the year. And then you would take the daily standard deviation of the portfolio. So let's say this is, let me just try to have this clear. So in your notes, so you have the daily return, and then you're going to multiply that by 252, because there are 252 trading days in the year. Then you're going to have the daily standard deviation, and you're going to multiply that by the square root of 252, because there are 252 trading days in the year. And once you get the annual expected return and the annual standard deviation, then you multiply that by the Z-score, and you just follow this formula here, and that'll give you what the annual VaR is. So hopefully you found all of this helpful, and you have a better understanding of what VaR is and what the expected shortfall is. And if you have questions, drop those in the comments and I will try to get back to you with answers. But in the meantime, don't forget to subscribe to our channels, and best of luck preparing for your exams. Thank you.